Today we're going to have an interview and a discussion with Peter Greenlee. Peter Greenlee is a consumer bankruptcy attorney, and he's here today with Occupy Duluth. He practices bankruptcy law in Minnesota and western Wisconsin. Peter, thank you very much for coming to Occupy Duluth and sharing your knowledge with us here.
Well, thank you for inviting me and sharing with me your premises. My name is Pete Greenlee, and I am a bankruptcy attorney, and I represent people and small businesses in bankruptcy, chapters 7 and 13 primarily, in Minnesota and western Wisconsin. I want to say a few words. I happen to know that there are many people, like myself, who work with people in need, from credit counselors, social workers, crisis workers, volunteers, and all those who help people in need in our communities. And we want to say thank you to those of you who've had the courage to stand out and stand up and speak up for those who don't seem to have a voice or the representation in our society. The poor, the downtrodden, people who've lost their jobs, their homes, their dignity. I want to thank you for starting a dialogue and for bringing attention to the legitimate concerns and needs of the 99%. Today I want to talk briefly about three things. First, I want to tell you what I see every day in my bankruptcy law practice. Second, I want to say a few words about the privatization of profits and socialization of losses. And finally, I want to ask for your help. Every day in my bankruptcy law practice, I meet good people who've fallen on hard times. I meet people who have suffered an injury, an illness, who have no health insurance or not enough health insurance. I meet elderly people who can't afford their prescriptions. I meet people who've lost their jobs and who've had their unemployment cut off. I meet people who've gotten divorced or separated and cannot afford to own a home. And I meet people who simply cannot afford their homes, which are underwater. These people are not freeloaders. They're not losers or irresponsible people or lazy. They're our family, friends, and neighbors. They're the former middle class. They're construction workers, small business owners. They're retailers, landlords, and renters. They're people who've placed their nest eggs in real estate and the stock market only to see their nest eggs wash away practically overnight. People who were told that their investments were safe, and people who've cashed out their 401ks and IRAs to try and pay their debts. In the years 2000 to 2008, banks and credit card issuers and mortgage lenders got something they wanted: an almost complete lack of regulatory framework and oversight, and an erosion of consumer protections. Payday lenders and credit card issuers have become like loan sharks, allowed to charge insane interest rates under hazy and convoluted terms and conditions. There is no more consumer protection, no barriers to combining securities with banking functions, no limits on market speculation. Our investment banks became nothing more than giant casinos, making extreme amounts of money off commissions for setting up bets between investors. Their focus was not on creating jobs or any other benefit to society, but rather to increase profits and their own share price. Mortgages were provided to anyone without question. Credit cards issued to any carbon-based life form. National lenders were interested not what was in best for consumers, but rather on increasing their market share and becoming the biggest volume dealers of mortgages and credit card loans. Mortgage brokers were allowed to sell whatever mortgage would generate the biggest commissions without any regulation. A mortgage broker could find a mortgage, for example, find a customer a mortgage at 7%, but also a mortgage at 10%, and not even tell the consumer that they could get them the smaller interest rate, and yet pocket a premium commission for selling the higher interest rate loan. It was called a yield spread premium. No regulations existed to regulate the mortgage brokers or to protect consumers. Investment banks packaged pools of mortgages and sold bets on these pools to pension funds and other institutional investors. And as we now know, they were hiding from these investors the true risks of these gambles, of these bets. Rating agencies like Standard & Poor's, Fitch, and Moody's were not doing their job. They were not acting as an honest risk assessment company, but were instead in bed with the investment banks. They were not doing diligence. In fact, they were coerced into giving good ratings to risky investments for fear of losing ratings business. Moody's, if you don't give this subprime mortgage pool a AAA rating, we'll take our business to Standard & Poor's and we won't hire you again because you're paid by us, the investment banks. Credit card user, if you miss a payment on credit card A, we can increase your interest rate to 32% on credit card B, a universal default clause it's called, which means that a person's credit card rate can go into default even if no payment on that card was ever missed. Credit card issuers will encourage people to charge everything and anything on credit without any disclosure as to what that credit was actually costing. Credit unions cross-collateralize loans, where a person's car loan would become collateral for a ready reserve checking account. Without informing the consumer, the rallying cry for banks was, and for some politicians still is, let's get rid of all consumer protection and all regulations, because you can trust us. You can trust us to do right by you, to not mislead you, and to protect your investment and loan you a correct amount of money for your home. At the same time this is going on, credit card companies like Chase, MBNA, and Bank of America spent over $100 million lobbying and donating to Congress members to change the bankruptcy laws. Although the actual default rate on credit cards and loans was under 5%, and although lenders were charging high interest rates to protect those small losses, these lenders paid the congressional minority to change the bankruptcy law. They said those irresponsible consumers are filing bankruptcy when they can afford to pay their debts. There are loopholes. Why should you be able to have a cell phone or a cable TV and not pay off your debts? Never mind that you lost your job or that you became ill. People who file bankruptcy must all be losers who simply don't want to pay their debt or were irresponsible in their spending. And finally, in 2006, Congress passed a new bankruptcy law which punished those most in need of bankruptcy by making it harder, more expensive, and more difficult to file bankruptcy. Now, bankruptcy can be filed today, but not without taking, for example, a budgeting education class, not without seeming to say that if you file, you must be stupid, not without having a newspaper like the Duluth News-Tribune publish your name in the paper for no other reason than to embarrass people and sell papers on their yellow journalism. In 2008, we found out who the real losers were when it all came crashing down, and we now know that it was the mortgage lenders and banks who were taking the crazy risks and acting irresponsibly. They were the folks who set up a fake recording system where mortgages and loans were sold, assigned, and resold into packages, and set up fake servicing companies and recording systems where even today many people do not know who actually owns your mortgage or your mortgage loan